Thank you very much. It's exciting to be here. I haven't been to an event like this since COVID, so it's good to be in person and see people. I'll try to make the presentation very brief so we can actually have hopefully a discussion or go back to some of the concepts in more detail. For those of you who don't know, just very quickly, MMG Capital, we invest in mining companies and we also help raise equity, debt, advise on joint ventures, strategic partnerships, and we work across the minerals from precious metals to battery metals, steel, and raw materials for steel. We have a portfolio of investments also in various geographies, in various commodities, and we work with a large portfolio of financing partners like private equity funds, debt funds that specialize in mining, trading houses, family offices, and strategic mining companies. We don't work so much in retail space. So just a very quick overview. We're almost in the best of all worlds scenario, almost, and I'll get to that. We have basically seen basically a V recovery. I remember in March of 2020 when COVID hit, a lot of pundits, especially in the mining sector, were thinking that this is going to be an I means it's just going to go down. And then, or it's going to be an L or whatever letter you can think of. But by and large, we had a rapid recovery and the prices are back into levels we had last seen in 2012, and the price forecasts are quite bullish. This has improved the economics of many of the projects, and so it has helped their NPVs and IRRs. And financing has become way more available. It's really interesting. We've seen a lot of financing and we have been able to raise financing much easier. There are some constraints, and that's why it's almost best of all worlds. We still don't know what's going to really happen with COVID, whether some variants is going to come back, and more than anything also reduce productivity, because in a lot of mine sites production is harmed when there is cases of COVID, and then they cannot function as perfectly. And also there is China. You keep every other day you hear a different story about their growth forecasts, and as it goes below 6%, it has a huge repercussion on the markets. So that's still an unknown how they will deal with their deleveraging, these Evergrande story and all the other things. And also we have seen a lot of expenses in transport costs of materials, and that's having an impact on, and also delays in execution, like delays in getting materials, equipment. I have a number of clients that have delayed their exploration programs just because they can't get drilling rigs on time. So there are these constraints, but I would say financing is getting done in all the commodities, with one exception, which is coal. We were working on a coking coal project, which was profitable, making a lot of money, and now coal prices have really shot up. But basically banks and most of the funds no longer fund coal projects, and they put coking coal in the same basket. Outside of, I think, that one commodity, I would say most of the other minerals, we're finding it easier to fund. Of course, depending on the equity story, which I'll get to in a minute. And the budgeting for exploration projects has also increased, not quite to the same level as before in 2012, but it has increased because they have been able to raise the financing for it. What we have seen is that, again, the recovery has been amazing in the metal prices, and as you can see here, I wanted to just show you this one point, that the price of commodities are back to where they were in 2012, but the budgets for exploration is still half of what it was in 2012. So they are rising, but they're still half of what it was in 2012. And largely it's because of some of these constraints that we were talking about earlier, and this fear of what's going to happen to China. So there's not always. A lot of companies are still cautious about how to aggressively expand their exploration. This is also interesting that the prices of commodities, as I was saying, has really gone up despite a backwardation. So this is a consensus of forecasts by all the analysts, not all, but a large number of analysts. I forgot the number that S&P tracks. And you can see that across all commodities, the prices have gone up. These are different commodities like gold, zinc, copper, nickel. And there is a backwardation, meaning that in the future years, these are the years 2020 to 2025, the prices are going down in the forecast, but not much. I mean, there is a rise in prices. So, compared to 2019, 2020, the forecasts are going from 1,800 to 1,600, but still way above 1,400 that we saw in 2019. Similarly for silver and copper versus what they were before. So silver is forecasted to go from 25 to 21, but still much higher than 17. So the reason I'm mentioning this is because obviously price forecasts are key to calculation of NPV and determination of the economics of projects, and that will have an direct impact on raising funds. This slide shows you about the increase in financing and also funding of the exploration projects. Just very quickly, I wanted to point out here that there has been a $3 billion increase in exploration, but most of it, sorry for the fine print, but these two, this is gold and this is copper. So most of the increase in exploration project has been in gold and copper in terms of dollar amounts. The fundraising really peaked in March of this year. So from the low levels of 2020, it's basically gone straight up. The number of deals haven't oscillated back and forth, but in each but the amounts have raised. So, for example, we were raising for a copper mining company in Namibia. We were trying to raise money in 2020. We were having a hard time raising $2 million in March, April of 2020 at the heart of COVID time. But only 6 months later, and that was at a price of 5 cents, and only less than 6 months later, we were able to raise more than $7 million at a price of 15 cents. So 3 times the price and 3 times the fundraising. So that was on one example, but when you look at the macro level, it went really high up. And then it came down during the summer months, and then it's picking back up now in the September-October timeframe. This data again is coming from S&P from September. And then this rise of commodity prices has hugely impacted the market caps. So the market cap of mining companies was below $1 trillion. It's more than doubled to over $2.2 trillion. Most of the cyclicals and materials have been actually leading the various indices. And this increased market cap and increased liquidity also helps a lot in fundraising as well. So we're actually in a virtuous cycle in raising funds for a lot of the junior mining companies. I think if you're a junior mining company, I would recommend while the window is open to raise money now. Very quickly, I wanted to show you, I showed this slide about 3 years ago as well, but there has been a couple of major changes in my view. One has been regarding private equity funds. So what this is that this is a graph of the mining cycle of a mining company. Sorry, the cycle of a mining company going from prospecting all the way to full production. And during each phase, it attracts different kinds of investors. So initially, you're basically dealing with retail and core investors. I'm talking about in general, and I'm also talking about junior mining companies. As it grows and has 43101, it attracts more funds. But I would say it's still retail and the original investors. Then, as it has PEA, PFS, it attracts more institutional investors. Now, what before we had a number of private equity funds focused in mining companies that would be interested to invest starting at this level of 43101 or PEA. But a lot of those mining funds are now in their Fund 3, Fund 4, and they have been able to raise a lot more, and they have graduated from funding these early stage companies, and now they are basically funding close to production at bank of feasibility study or even above that. So it really moved. These private equity funds, I would say, 3-4 years ago, they would fund this. A lot of them have moved to close to basically funding at this phase. That's one big change that we have definitely seen, and we work with about 75 private equity funds in the mining space. And there are few that are coming up. There are few that invest. There are few private equity funds that invest in this space, but by and large, they're here. Each of these categories of finance providers have different things that they really care about. So I would say that we deal with 4 groups of investors: strategic investors, private equity investors, funds, and then non-bank debt providers like trading houses and debt funds. And although obviously equity story is important for all of them, asset quality is important for all of them, and the later speakers will speak to that, there are certain things that matter more for others. So I'll just quickly mention some of those, and then we can discuss it during the Q&A. For strategic investors, they go very deep into the technical evaluation of the project. Size matters for them, so they're only interested in projects that can be really moving the dial for them. So if it's in gold, it has to be like 3-4 million ounce potential or more. And down the line, we can discuss the other commodities. And also, there should be geographic synergies to whatever other projects they're doing at the time in that area. For private equity funds, exit strategy is really important. They have to see that the project they're investing, how they will exit. If it's not IPO, then who will they eventually sell it to? And they do also do a very deep dive into technical evaluation and the equity story. Maybe they sign NDA and do site visits and quite detailed evaluation of the projects. And they also need to have a full visibility to the full funding all the way to production. And if they don't see that the project will be successful in raising the future capital, then they tend to shy away from investing in it. And they also investigate very deeply the permitting process and execution. I think public equity funds, by and large, they follow similar things, but I would say they don't do as much of deep dive due diligence. They don't sign NDAs and go into extreme detail. They care also, besides the equity story, they care a lot about liquidity of the stock and the dilution in the future fundraisings, the dilution that will be caused through warrants. So they really look at the price of the offering, the dilution, the warrants, all of those things. Some like warrants, some don't like warrants. So there's a mix there, but there's a lot of attention, and they want to also invest in something that will, increase 10 times in the near future. So they're picky in that front, but by and large, that's why a lot of the small junior mining companies are having a hard time still to raise money from funds because of this liquidity issue, even if they have a good equity story. Then the non-banks, they basically only come in when for the debt financing, when there's a bank feasibility study and there's great visibility that permits will be in place in short order. They do a good detailed technical evaluation as well. With trading houses, we work with a portfolio of trading houses across base metals, and they also want offtake as well. And they really go into detail about the execution risk as it comes into production. This is a table that we have developed with our proprietary database of going through 500 of the mining companies and in which minerals attracts which funding providers. Some like trading houses are more focused on base metals, streaming and royalties focus more on precious metals. So there is a diversity, and when you're raising funds in your particular commodity, you really should know your audience and where you can raise that money best. We can come back to this table during Q&A. I don't want to go through it in detail. Just a couple of points to mention is that I know there are talks coming up later after me that will go into this question in much more detail. So of course the economics matters. Most funding providers want IRRs of more than 20%, and they want the cash cost to be in the lower quartile in order to, if the prices come down, the project can still be profitable. But there are many other factors besides the economics that matter. The management team, and the management team, there is a lot of nuances that who has, they want the management team that has actually worked on and has a track record in that particular geography, in that commodity. So even if the guy did a great job of, has a track record of doing gold projects in Ontario, that doesn't mean that they can develop the same gold project in Western Africa. So investors want to see track record in the same geography, basically, and also have a board that's very diversified and brings in not just technical but also corporate finance skills. So it's a diversified in terms of skill level and track record. Just a couple of other points I'll mention here is that jurisdiction matters a lot as well. Many countries in in Africa, for example, have a high cash cost, all-in cash cost, also because a lot of the share of the profit go to taxes, royalties, license fees, and so on, and there's less share for the investors. So mining is a very competitive field, and depending on the, investors have a choice of jurisdictions, and if one jurisdiction is not as competitive as others, they just won't go to it unless the grades are really amazing or there are some other compensating factors. And then security, infrastructure, supportive communities. So all of these are well studied by investors, and we can go through them during Q&A. And I'm sure other speakers will talk in more detail about this. The management has to deal with a large laundry list of risks, and from commodity price to country risk. And then, despite the recovery that we have seen, there's still risk aversion to some extent with investors, and I'll come back to this during Q&A as well. But they do pay attention to a lot of costs that normally you don't see, like security costs, if the project needs to have a lot of infrastructure developed, what are the costs of that, what are the delays in doing that as well. So finally, I just want to wrap up with this summary slide of what we have seen. I've talked about this 3 years ago as well, but things have become actually more positive. I would have said it's almost impossible to the left of this table if the capex is 30 times the market cap. It's almost impossible to raise money. But actually, we are finding that all of these categories, like even if capex is huge multiple of the market cap, or the deal sizes that the capex is over $1 billion, they are getting financed, and in today's environment. But I would say that the important thing to bear in mind is that it's a continuum of more difficult to easier in terms of raising funds. So the closer the capex is to market cap, in terms of it's easier to raise money. When the deal size is between 50 to 500 million, it's also easier to raise money. Below that, a lot of the banks won't do project financing, and above that, it becomes difficult to complete the capital structure. The all-in cash cost, when it's within 20% of commodity price, it does become very difficult to raise the money. So there has to be a nice margin between the cash cost and the current market price. There's two other things that are important. Is time to production. Again, much more difficult when you have 4, 5, 10 years from production, and when you have complex mining compared to easy mining of open pit versus underground. And then also they look at this last point about burn rate and the cash position. When you're raising money and you have less than 1 year of operation left, it becomes very difficult to raise money because people think you're running out of money and you have to issue a lot more shares in a short time frame in order to have the financing, and there will be a lot of dilution. So this becomes very difficult. So when you're well funded, that's when actually you should be raising money. So those are just some brief remarks, but I'm happy to answer the questions you have. Thank you.